Guys, Lockheed Martin just reported earnings. They reported $16.58 billion in revenue with expectations of $16.71. So they missed there, but they reported $6.87 on earnings with expectations of $6.59. So they beat there. The stock is currently up almost 3.5% during the day. Let's check it out and see if it's something that makes sense to us. So in the last year, they had a high of 480 and a low of 325. Let's see here. Okay, so some of the things I like here. 5-year profit margin of 8.8%. 1 year, the last 12 months of 7.3. The reason I like that is I don't like it when there's a huge jump relative to 5 years. When it's lower, everything mean reverts. So I'm hoping this will mean revert at some point. Very low gross profit margin. Why is that? Well, they're a government contractor. They probably do some sort of cost plus model. Not much margin in there, but it works right here for them. The trailing 12 months dividend yield of 2.7%. Pretty ample. $3 billion eats up a big chunk of their 5-year free cash flow, more than I'd like. But again, this is the kind of company you're not going to get a lot of growth out of because it's really dependent on the government mostly. But their last 1 year of free cash flow, $7.5 billion versus a 5.3 average. Okay, kind of good. Let's go check that out real quick before we go to the 8 pillars tab. So this is their free cash flow numbers. 2.6, 4.6, 6.89, 5, and 7.5. So a big jump in the last year, but a big drop in 5 years ago. So it kind of evens itself out maybe. All right, let's go to the 8 pillars tab and see what's going on. Oh, wow, it's an 8-pillar thriller. Look at this. Now, immediately off the top of my head, even though these are check marks, I don't like paying big premium for low margin businesses. And 7% isn't bad, but they have a high return on invested capital. But I wonder how they can really use that to get more profit for its investors. I mean, it's a government-based industry. They build mainly for the government. Go figure out what percentage of their revenue is from the government. I do like the increases in cash flow, $4.8 billion on $13 billion in revenue. So I like that a lot. They're buying back a few shares, which I don't know if it's necessarily a good idea when the stock is so high. Remember, when you're buying back shares as a company, you want to buy back cheap shares because it doesn't matter if you're buying your shares or somebody else's shares. The point is you're deploying capital into an investment, even when you're buying back your shares. So if your shares are expensive, you're overpaying for your own stock, which is no different than overpaying for another company's stock. So as much as we like this, I'd rather have this be steady at 0%, but we'll get into that soon. Reasonable debt levels below 5 times free cash flow with increasing cash flow. So overall, guys, this is I'm not terribly concerned about this. I don't look at this saying, ugh. So let's see what the analysts are saying about Lockheed Martin. All right, so on our software poll, we've got quite a few analysts here, 23 for 1 year, 14 for 5 years out, $21 a share up to 38, which is overall probably, what is that? Low double digits increases. That's pretty solid for a company like this. Revenue growth, not very high revenue growth, guys. Look at this. 65 billion to 73 billion. So not a lot of revenue growth, but I honestly don't understand how the EPS could be so high with such a low gross margin because their gross margin is 13%. But maybe they're expecting a lot of share buybacks. All right, so let's go to our stock analyzer tool. Now remember, before we go into this, I want you to remember this over and over again. When a company doesn't have a lot of growth potential, you've got to pay less for the company. Yes, Lockheed Martin probably has a very steady business model and the fact that they're government driven and it's Lockheed Martin. Everybody knows it. Everybody runs with it. Let's look at their income statement to show their revenue over the last 10 years. Not major growth. Actually drops here, increases, drop a little bit. It's one of those things where I really want you to focus on the longer term for this business. Don't look at year to year. Look at longer term, 5, 7, 10 years at a time, because you want to make sure you look at those profit numbers, and that's what the stock analyzer tool does. It allows us to look at 10-year profit, 10-year free cash flow, 5-year profit, 5-year free cash flow. Focus on these numbers. Look how consistent those are. That's what I like seeing. That's what I'm going to focus on here. You're going to sit here and make this company work for you based on buying at the low part of the cycle. All right. So my guess is that we're going to see a lot of red numbers here, but let's do the numbers here to figure it out. So revenue growth. I'm going to do 0, 1, and 2% because we saw low single digits. And I'm just going to say, hey, for the next 10 years, it's only 0%. Let's be conservative. Profit margin. I'm going to do 8.2, 8.5, 8.8. And the same with free cash flow. Because we saw here between 8.3 and 8.8%. So let me go a little bit lower. Actually, you know what? I'm going to do 8%, 8.4, and 8.8. Now, PE. The current PE is 23. The current price of free cash flow is 15. Remember, low growth business. Yes, it's stable, and that's Lockheed Martin. It's government driven, and I have a hard time believing the government's going to spend less money over the long haul. This is something we talk about in this channel. Governments get bigger, they want to spend more money. Congress wants to keep their jobs, they want to spend more money. So something tells me this is probably not going away. So I'm going to put in 13, 14, and 15. Because at the same time, you still need to be able to make your money off of dividends paid and building up the balance sheet to make it better. You're not going to get it through some sort of sale or something like that, unless there's some sort of merger. Now, desired return. Government-driven business, as you get higher in your assumptions, you need to get a higher return. This is your margin of safety. And buying a low-cost ETF will get you 9 or 10%. So in terms of margin of safety, you want probably at least 12%, and you have to decide as you make higher and higher assumptions how much more return you want. Guys, these are not high, insane assumptions, I don't think. So maybe I'm being a little aggressive on 14%, but that's okay. We can go from there. We can start from there. So I'm going to hit the Analyze button. Now remember, guys, 6 numbers are going to pop up. 3 as a multiple of earnings, 3 as a multiple of free cash flow. Don't forget, if they're all green, it doesn't mean you go out and buy. It means you go do more research to make sure these numbers are accurate. How do you do that? Go do your research on the internet, join our community at everythingmoney.com, talk to the thousands of people in there. Whatever you'd like to do, just go do more research to make sure these assumptions are correct. Because as great a model as this is, if it's garbage in, it's going to be garbage out. If you're making insane assumptions going in, it doesn't matter that it pops out. It's going to pop out insane numbers. So make sure your numbers are accurate. So scroll down, boom. A low price of 190, high price of 220, middle price of 200. Add it to your watch list. I'm going to add it to mine at this 225 number. That takes me to 100 stocks on my watch list now that the software is going to update me on. So this is a great video. If you made it this far, I guarantee you've probably sat there and said, okay, this makes a little bit of sense. So I need you to subscribe to the channel and make sure you get notified when our videos come out because we release 2 per day. It'll change the way you think about money. Thank you very much for your time.